Hello, welcome to our live session today with Peter. So, how have the markets been behaving?
Well, we had the US dollar extending its drop practically on Monday yesterday, more or less in anticipation of the release of the CPI rates for August from the US. It's a big issue about the markets. Markets are hoping that a possible slowdown could be signaling a pivot in the Fed's hawkish stance, if not a pivot, then at least an easing of the tightening of its monetary policy.
What happened with UK's GDP rates yesterday?
Well, we had the GDP rates came out maybe not as good as expected, but at least they were better than the previous month. We were talking about July. And for July, we had finally some growth in the UK economy. And that was also supported by the manufacturing output growth rate for the same month, for July, which reversed a reading of minus 1.6% month on month that was for June, and came out at around 0.4% month on month in the positives for July. So they were kind of mixed in the sense that they were better than the prior month, June, but were not as good as the market may have hoped for. By the way, we had also today during the early European session UK's employment data also for July, and there we had also some mixed results. We had on the one hand a drop of the unemployment rate to 3.6%, which is pretty low for UK standards. At the same time though, and that was the worrying part, we had also a wide drop of the employment change figure, which may imply that the UK employment market may have lost its edge and its ability to actually create new jobs. And that may imply that the tightening may ease somewhat. Last but not least, we had also the average earnings growth rate, which accelerated further, implying practically that the labor market in the UK is going to continue to feed inflationary pressures within the UK economy, given that salaries are still on the rise at a rather fast pace. So that could, on the one hand, create some doubts on behalf of the BOE. On the other hand, though, it could reinforce the idea of a wide rate hike in order to curb inflationary pressures.
How about US stock markets?
Well, US stock markets actually were in the greens. Dow Jones was impressive. And we have to note that once again the expectation of a slowing US CPI rate for August is improving the market sentiment, or at least it does not allow for a cautious sentiment to take over once again. Once again, I would also highlight that we have to wait and see how the actual release will play out and how the markets are to react.
Did gold's price actually benefit from USD's weakening?
Actually, yes, but not as much as we have hoped for. I would expect gold's price to rise substantially, given that we have a continuous weakening of the US dollar since Friday. Actually, it was since Wednesday. And that did not happen as such. I think that gold traders are still a bit cautious. And they want to see how the whole situation with the Fed will be playing out. And they're also keeping an eye out for US yields.
And what's on the calendar for today?
Well, we already had UK's employment data, we mentioned that. From Germany, we're getting the CEF indicators. And we have both the economic sentiment as well as the current conditions are to drop deep into the negatives, which would imply practically a more pessimistic outlook for the largest economy in the Eurozone. And at the same time, we have also the current conditions indicator, which is also dropping deep into the negatives. And that could imply that also the conditions on the ground for the German economy are deteriorating, both if actually they must be releasing right now, and if they drop deep into the negatives, they could weaken the euro.
Any final comments?
Well, more or less, I would like to see how the US CPI rates will be affecting the markets. I think that's the main pivot point for the market today. Should the actual rates and figures, so the actual rates decelerate as expected, we may see a slight bearish reaction on the US dollar, while US stock markets may be allowed to continue to rise. On the other hand, should the CPI rates of the US slow down even further, more than what the market expects, we may see the US dollar's weakening being extended, and US stock markets may rally. On the flip side, should US CPI rates accelerate despite markets' expectations for a slowdown, that could cause a significant rise for the USD, while US stock markets may tank.
Thank you, Peter. Stay tuned for our next live session with Peter.
Welcome to the technical analysis part of the presentation. In front of your screens you have the US dollar index. It's the 4-hour chart. All charts to be presented are to be in the 4-hour time frame unless otherwise stated. We're going to be issuing a warning when we're drilling in and out of into other time frames. For the time being, we see that the US dollar index's drop seems to continue. However, I would note that there was a slight correction yesterday and continuous drop during today's Asian session and European session. Overall, we tend to maintain our bearish outlook despite, and we have to note this, the index not being able to mark lower lows than yesterday's until right now. So on the one hand, we have a downward trend line which continues to guide the index. We also have an RSI indicator which is quite low. It's at 35. And that would also imply a rather bearish sentiment on behalf of the markets. On the other hand, there may be some stabilization tendencies. For the time being, we would maintain our bearish outlook. On a technical level, we highlight though that the CPI rate release for August from the US is expected to alter the index's direction. Either way, it could intensify its drop further and cause it to start aiming for 106.80. On the other hand, we may see a stabilization around 108, or even we may see the bulls, should the CPI rates God forbid accelerate, we may see the bulls gaining the momentum, pushing the index higher, testing or breaking the 109 resistance line. Let's have a look at Euro USD. Euro USD, which also seems to be showing some signs of stabilization, yet the upward trend line is still valid. For sideways movement bias, we would require clear breaking of the upward trend line incepted since the 7th of September. Let's have a look. Yep, since the 7th of September. And the price action in case of a sideways movement probably will be between the 1.02 and the 1.0095 levels. In the case that the bulls maintain control, we may see the price action jumping, maybe even pushing the upward trend line a little bit to the right, something like this, to create some space. Yet we would imply that the price action may bounce once again up on the upward trend line, push higher, and definitely would require a higher peak than the last one, i.e. that would mean practically to break above the 1.02 resistance line. In a bearish outlook, say for example, should the US dollar strengthen substantially, we may see the price action dropping, breaking the prementioned upward trend line, breaking the 1.0095 and start aiming for parallel level once again. There is one small catch I would like to have a look, if I'm allowed. Practically the release of Germany's CEF indicators. And let's have a look. So we had both the current conditions and economic sentiment for September dropping more than expected, deep into the negatives. It would be interesting to see how the Euro USD reacted upon the release. And we're drilling down to the 1 minute chart. And it was at 12 o'clock. Should be this one, yep. And we can see that the price action dropped from the highs of around 1.016, around 14 pips. Okay. So there was some market reaction. Quickly regained its cover, but seems to be slowly dropping. Going to be interesting to see how the market will be reacting also to the USD pair rate. Anyway, for the time being, we note that the RSI indicator is above the reading of 50. It's actually right now at 63, which seems to imply some bullish tendencies. On the other hand, we also have some distance between the upper Bollinger Band and the actual price action, allowing some room for the bulls to move higher or push the pair higher. And as long as the price action remains above the upward trend line, except since the 7th of September, we tend to maintain a bullish outlook for the pair. Once again, for a sideways movement, note the stabilization in the past 1, 2, 3, 4, 5, 6, that would be 24 hours. Note the stabilization for the past 24 hours of Euro USD. Should that be extended, the sideways movement, I would require for a sideways bias a clear breaking of the upward trend line and the price action to remain between the R1 and the S1. Let's have a look at GBP USD. GBP USD, which seems also to be rising, yet on the other hand seems also to be stabilizing. Once again, we have an upward trend line guiding the pair, and that tends to imply that the bulls are still in control. Mind you that the RSI indicator below the 4-hour chart is currently at 64, also pretty high. We tend to maintain our bullish outlook once again for the pair as long as it remains above the upward trend line. In which case, should the bulls maintain control, I wouldn't be surprised to see the price action breaking the 1.1755, which provided resistance here and support here, and start aiming for the 1.19 resistance level. That would be the R2. Should the pair stabilization prevail, for a sideways movement bias, we would require clear breaking of the upward trend line, somewhere here, The price action probably to respect the 1.1645 support line and their 1.1755 resistance line. So that would mean that the price action would remain between the two. For a bearish outlook, we would require a clear breaking of the prementioned upward trend line, definitely a break of the 1.1645 support line, and the price action to start actively aiming for the 1.1450, landing practically at levels seen on the 5th and the 7th of September. That would be cancelling out the upward movement which was incepted since the 7th of September over this level here. Let's have a look at Safe Haven USD JPY. USD JPY, which actually broke the first upward trend line and has stabilized. Let's readjust the levels. So we tend to maintain a bias for a sideways motion for now. Note how also the RSI indicator is running along the reading of 50, implying a rather indecisive market. It's characteristic how Safe Haven JPY's behavior differs from the euro and the US and the GBP against the US dollar. So probably for now we tend to maintain a bias for sideways movement to be confined between the 1.4350, which provided resistance here, and the 141.50 providing resistance here. Should the bulls regain momentum, we may see the price action breaking above the 143.50 and start actively aiming for the 145, which was peaked practically around the 7th of September. Let's have a look. Yeah, on the 7th of September. For bearish outlook, we would require the price action to drop, break the 141.50, clearly break the upward trend line incepted since the 11th of August, this one, and start actively aiming for the 139.05. Let's have a look at the other safe haven currency, that would be USD-CHF. USD-CHF, which seems to have regained momentum for the bears. In which case we may see the price action dropping, breaking the 0.9480 support line, and start actively aiming for 0.9375, which provides support here. Should there be a stabilization given the slowing of the downward movement, we may see the price action remaining between the R1 and the S1. For a bullish outlook, I would require a clear break of the 0.9610 and the price action to start aiming for 0.97. Mind you that the RSI indicator below our 4 chart is below the reading of 30, implying a strong bearish momentum. At the same time, though, may also imply that the pair has reached oversold levels and may be ripe for a correction higher. On the other hand, though, you can see that the price action has still some distance from the lower Bollinger Band, which implies that the bears still have some room to play here and could push USD-CHF lower. It's very interesting how differing monetary policy outlooks are practically altering also the direction of the trading instruments. So for example, we had USD JPY, which is a safe haven, remaining rather stable against the US dollar, while safe haven CHF seems to be strengthening against the USD. Moving now to commodity currencies, we can start with USD CAD. USD CAD, which now it's on the verge on breaking or not breaking the downward trend line. Let's readjust. Now there are some signs of stabilization. You can see that latest 1, 2, 3, 4, 5, 6 candlesticks have remained in the same area. On the other hand, the pair seems to be hesitating. The bears seem to be still struggling to keep in control. And the RSI indicator below the 4-hour chart is pretty low. It's near the reading of 35, which tends to imply that there is still some bearish sentiment for the pair in the markets. Should USD CAD actually drop further, I wouldn't be surprised to see it breaking the 1.2945 and start aiming for the 1.2830, providing support here and all the spirit here. On the other hand, should the stabilization take place, I wouldn't be surprised to see the price action, or if you prefer, I would require for the price action to break the prementioned downward trend line, and the pair will be probably remaining between the 1.2945 and the 1.3075. For a bullish outlook, I would require a clear breaking of the prementioned downward trend line, a breaking of the 1.3075 resistance line, and the price action to start aiming for the 1.3205. Let's have a look now at AUD-USD. AUD-USD, which has been rising. Okay, we're going to be requiring a full. So we have an upward movement. Somewhere here. Note how we are readjusting the support lines, and we make a start with the 0.6860, which is the first support line. Given that the price action found support here once, twice, 3 times, 4 times, 5 times, that's pretty valid. Second support line is being set here. Given that there was some attempts to drop lower, but they were prevented by the 0.68. Let's have a look. 20. And even lower, we note this level providing support here and here, and that would be the 0.6770 in green. Okay, let's go hunting now for a new resistance level. It's actually pretty close to the price action. It was tested here. Seems valid. Let's keep this. And that would be the 0.69 in red. 20. Even higher, we have another one. at 0.6955. And the final one to be placed, this peak here, double test, and keeping this, that would be the 0. Let's color this in red, 7010. Let's widen it. Let's label them. Second resistance line being placed at 0.6955. First resistance line being placed at 0.6920. First support line being placed at 0.6860. Second support line being placed at 0.6820. And first support line being placed at 0.6770. For the time being, we maintain a bullish outlook, and as long as the price action remains above the upward trend line, we tend to keep it. First possible stop for the bulls could be around the 0.6920. Higher than that, we note the 0.6955 as it provided resistance here, support here, and even higher we note the 0.7010. On the flip side, should the pair decide to stabilize, we may see the price action breaking the pre-mentioned upward trend line, yet remaining between the 0.6920 and the 0.6860. Mind you that the RSI indicator is above, it's actually near the reading of 70, it's at 66, which is somewhat bullish here, supporting the idea of a upward movement to continue. Also note how the price action has still some distance to cover before it reaches the upper Bollinger Band and it's being capped. For a bearish outlook, we would expect or would require the price action to break the upward trend line pre-mentioned, definitely break the 0.6860 and start aiming for 0.6820. Mind you how the bears found support here and here. Even lower, we note the 0.6770, support here, and here, resistance here. So that seems to be a valid level as well. Let's have a look at the Kiwi. And the DUSD, definitely some readjustments are in place here. No, I'm not keeping this one. It's a little bit too wide. No, I'm keeping it. And that would be the 0.62. Yeah. Once, aimed for here twice. Yeah. Next level would be the 0.6350, and let's go hunting for another one. I don't like them because they're too wide from the price action. Let's narrow them. One could be placed here when we had extensive testing of the level, and that would be the 0.6305. And then another mid-level here. 0.6385. Note, aim for here, and let's go a little bit further back. Once again, test it here. Seems good. Support lines seem to be valid. Okay, let's keep that. So, final support line being placed at 0.6385. Second support line to be placed at 0.6305. First support line being placed at 0.62. First support line being placed at 0.60.95. Second support line being placed at 0.60. And final support line being placed at 0.5910. Let's widen this. There you are. Okay, let's also show the direction of the price action for NZD-USD. That should be it. So we tend to maintain a bullish outlook as long as the price action remains above the upward trend line, yet we highlight that there are tendencies of the pair to stabilize. It's characteristic with these set of candlesticks. A failed to actually provide a substantially higher peak than the prior one. It's pretty close to the prior level, while the price action seems to remain at around the same levels, even if not dropping a bit. So should the bulls maintain control, I would be surprised to see wouldn't be surprised to see the price action bouncing on the upward trend line and aiming, if not breaking, the 0.62 resistance level. On the other hand, should the stabilization occur, I wouldn't be surprised to see it breaking the upward trend line, yet respecting the 0.62 and the 0.6095 levels. For a bearish outlook, we would require clear breaking of the prementioned upward trend line, a break of the S1 0.6095, and the price action to start actively aiming the 0.60 support level, practically relenting the gains made since the 7th of September. Let's have a look now at gold's price. Gold's price, which interestingly enough has risen, but not to the extent we had hoped for. Let's show that with an upward trend line. There you go. Let's also go hunting for a new resistance line. I'm going for the peak. $1,800. Let's widen this a little bit. There you go. Second resistance line being placed at 1765. First resistance line being placed at 1740. First support line being placed at 1720. Given that the price action broke above it, but not only that, it also found some support during today's European session. 1690 being the second support line. And final support line being placed at 1660. So for the time being, we tend to maintain a bullish outlook for the precious metals price, which could drive it higher, breaking the 1740 resistance line and start aiming for 1765. On the other hand, we highlight that the peaks seem to have not been able to create a new higher peak, a higher high. So some stabilization seems to be in play, which could allow gold's price to break the upward trend line incepted since the 7th of September, probably remaining above the 1720, yet below the 1740. It's a $20 distance here. Should the bears take over, I wouldn't be surprised to see the price action dropping, breaking the pre-mentioned upward trend line, breaking the 1720, and start aiming for 1690 support level. WTI's price which has risen. So let's correct the labels once again, turning them from resistance to support. Based on the peak here, that would be in red, 1997. And the final resistance line would be based practically on that peak here, and that would be the 100. Oh no, 101. Yeah. Let's widen this in red, please. Okay. So let's make a start with the 77.45. Support line is the lowest one. Second support line being placed at 82.60. First support line, practically the first line of defense against the bears, would be the 87.20. First resistance line being placed at 92.60. Second resistance line for the bulls would be the 97. And final resistance line being placed at 101. For the time being, we tend to maintain a bullish outlook for the commodities price, and as long as the price action remains above the upward trend line, the bullish outlook seems to be holding. Mind you that the RSI indicator is slightly high, it's at 60, which may imply slight bullish sentiment on behalf of the markets, in which case we may see the price action of WTI jumping towards the 92.60 resistance line. On the other hand, the stabilization is also possible, given that we have, for the time being, a lower peak here. The price action is still below the latest peak, which would practically imply that the price action in a sideways movement could be breaking the upward trend line and revolving around the 87.20 support line. For bearish outlook, we would require a clear breaking of the upward trend line, a breaking of the 87.20 support line, and the price action to start actively aiming for the 82.60 support level. Let's have a look also at US stock markets, making a start with the Dow Jones. Price action which has broken the 31,955 resistance line, now turned to support. We have a wide spectrum here. We have peaks here and here, peaking the latter. That would be at 30,970. Okay. Just it's interesting how the caps. Let's also note some fourth resistance line at the peak here and a support line at the true. And let's draw also a trend line. Okay. There's a clear upward movement and we tend to maintain a bullish outlook for now. Final resistance line being placed at 30,955. Second support line being placed at 31,345. First support line now being placed at 31,965. First resistance line now being placed at 32,000 and a half. Second resistance line being placed at 33,470. Correct this. And there are three now being placed at 33,970. Once again, we maintain a bullish outlook, which could practically lead the index to break above the 32,500 resistance line. A stabilization could be signaled by breaking of the pre-mentioned upward trend line. Yet at this point, it would be interesting to note that there is a middle level here, which is being placed at this peak here. Yeah. Let's widen this again. In green, 32,370. $31,955 and 31,345. It will all come down to the CPI rates today. Should the CPI rates actually slow down, and even slow down more than expected, that could cause your stock markets to rally. Should the CPI rates accelerate, in contrast to the market expectations, I would expect your stock markets to drop. In this case, I would expect the Dow Jones to drop definitely below the 32,370, break the pre-mentioned upward trend line, test if not even break the 31,955. That should be it from our side for today. From all of us here at IronFX, best wishes for solid trading.
Hello, my name is Christina, and today we will talk about forex pairs, US dollar versus Japanese yen. The dollar, also known as the greenback among traders, is the currency of the United States of America, the world's largest economy in the world. The yen is the currency of Japan, which is the world's third largest economy. The USD-JPY currency pair indicates the exchange rate of how many Japanese yen are currently needed to buy $1 US on the forex market. The currency pair is one of the most popular major currency pairs and is characterized by low volatility and high trading volume daily. Forex traders who want to trade the USD-JPY and make a profit from the price difference can trade the currency pair when the value of JPY is lower and then sell when it rises. Some suggest that the best time to trade the pair is between 12 o'clock and 3 o'clock GMT, and this is when London and New York markets, but not Tokyo, are open. Let's see a bit more in detail why traders choose this currency pair. USD-JPY has low spreads, which means low trading costs. The currency pair has high liquidity. And finally, when trading this non-volatile currency pair, usually means predictable and easy trading. Now, let's see which factors can influence the pair. Both currencies are safe havens, so if global market sentiment is down or global economic conditions deteriorate, they both tend to go up. If the dollar strengthens as a safe haven and Asia looks less attractive, then the USD will rise against the yen and vice versa. Central bank comments such as the US Fed and the Bank of Japan usually have an immediate effect on the pair. Finally, economic data from both countries, such as employment numbers, consumer confidence indicators, and growth figures also influence. The important thing to remember is that USD-JPY is sensitive to global risk and market sentiment, as well as the performance of stock indices, as the pair is positively correlated with major US stock indices and US bond yields. The USD-JPY is not very volatile, so traders can make profits from the smallest market movements. At the same time, there are trading risks to consider, such as the lack of significant volatility that may put off some traders. Unpredictable events, inconvenient market hours due to time difference, as well as inventors from the Bank of Japan can also deter some traders from trading this pair. Thank you for watching.
The aim is to help you guys grow as traders and help you grow your account. Like if you guys, we ultimately want you guys to be winning in trading, okay? So don't be shy, ask any questions you want to. A little bit about me, okay? My name, again, Cass, you guys can call me Cass. In terms of trading, I mean, I've got quite a bit of experiences. I don't think it's like necessary to mention it here, but like focusing on trading, right? I'm personally managing it's more than $1 million now, $1 million US on my own personal account. I've been quite profitable for a while. So I've passed FTMO twice and my Forex fund twice. For those who don't know what these are prop trading tests that requires you to be 10% in profit, okay, each time you take the test. So I've passed these tests month after month after month. I'm consistently still profitable. Most months I'm about 2 to 8% in profit. Okay, so I usually make 2 to 8% per profit. And today, whatever I share with you guys today is basically my way of trading. There's many ways of trading out there, right? There are like reversal traders, I don't know, scalpers or whatever. So today it's just my way of trading and how I managed to get that 10% every month, or like 2 to 8% every month on average. Okay, so again, our question: why do you trade with both prop firms? Is it just a bigger account? Okay, so why I trade with different prop firms, okay, is because one prop firm requires you to do 10% to pass, while the other one requires you to do 8% to pass. Okay, so when I was doing my forex fund, I actually passed my forex fund, my forex fund in 5 days. Yes, I made 8% in 5 days, but I was going very aggressive. Okay, so I was just trying different prop firms to see which one is more reliable, because in case one closes down, for example, at least I still have the other one going. I'm also prop trading at Everest Fortune Group, so I am prop trading at multiple places and multiple firms. But yes, the whole point of me telling you guys is that I do have a strategy that is quite profitable. My strategy focuses on continuations, actually reversals and continuation. Okay, and yeah, I hope you guys learned something from my webinar. Hopefully, I hope you take something useful on my webinar. Okay, so let's just go through our agenda for today. We're gonna go through key approaches we take to trading, the cheat sheet checklist, and then we're gonna move on to multi-time frame analysis. Okay. Okay, so this is basically the checklist that I use when I'm looking for a trade or a setup. I know it looks like it's a lot, but honestly, maybe because I do it so often, usually it only takes me 5 to 10 minutes. Okay, maybe 10 minutes on average, 10 minutes to go through a particular pair, a particular chart to look for a setup. Okay, but this is basically what I go through. Every time I go on the charts, I will ask myself, do I see any horizontal level? Do I see any trend line? Do I see any channels? Do I see any chart patterns, dead cross, golden crosses? Do I see any natural moving averages? Then I pull out my indicators. And then for reversals, do I see all of this? And for breakouts, do I see any of this? So if you guys want to take a screenshot or whatever it is, maybe jot this down somewhere. It is a useful checklist to refer to, right? I'm not saying, okay, sorry, I don't use this for all my trades, but majority of my trades, I use this, okay? And I think it's a very good checklist to refer to. You can come back and just refer to it. Did I look out for this when I'm looking for my analysis? Okay, so that's that. So a lot of my trading focuses very much on, actually here at Everest Fortune Group, we focus a lot on Fibonacci. So Fibonacci confluence, I think, is a very, very powerful and strong tool, okay, to look for setups. Why? Because when you look at the markets, you look at the charts, you kind of see it going in a downtrend. So you have a rough idea that it is a downtrend, right? So you have a rough idea that it is a sell. It is sell. But how do you pinpoint or narrow down exactly where the reversal is going to happen or your exact entry? That's when you use Fibonacci to narrow it down and kind of like refine your analysis. Okay, so today we're going to be using a lot of Fibonacci as well to refine our analysis. For those who never have never attended my webinar or new here, I'm going to just run through a analogy that I use, right? I'm just going to run through an analogy that I use whenever I'm using Fibonacci. I think it's a very good one. It's a very silly or maybe simple analogy, but I use it, and every time I think of it, okay, that makes sense. I should be using that. So I'll tell you guys when we move on to the charts. For those who are here every week, you guys already know this analogy. Can you explain the basics of Fibonacci starting from point to endpoint? Okay, I can just quickly run through Fibonacci because today our main focus should be multi-time frame analysis. So I'll just briefly run through Fibonacci. Okay, this is a retracement. Okay, I would need a pen to draw it out for you guys. So later when I move on to the live charts, I will use the pen tool so that I can explain in more detail how to use Fibonacci. But basically, these are some of the Fibonacci. This is the Fibonacci retracement. You pull from the swing high to the swing low, and then you get some of the level you think price is going to retrace. So this is the projection where you're projecting price to go after from the 3 points. Let's move on. This is called, okay, this is called the expansion. Expansion, you are basically looking for negative levels on the Fibonacci, and this is the extension. kind of looks like a Nike tick. You guys see this? It kind of looks like Nike, you know, the shoe brand Nike, the running shoe brand. Okay, so it kind of looks like that, and we're gonna go into the live charts. Okay, let's move on to the live charts. Oh, and this is confluence, where we combine all Fibonacci levels to pinpoint exactly where we think is the most probable or most likely place of reversal and reaction on the markets. Okay, thank you for sitting through the introduction. We're gonna go on to the live charts, where I'll just quickly and briefly explain Fibonacci before we go into our main aim today, which is multi-time frame analysis. Okay, just give me a moment to switch to the live charts. So I'm just gonna quickly run through Fibonacci, so that's for those who are new here, you guys, it's easy for you to follow. For those who have heard this so many times already, just bear with us, right? We want to make sure more people can follow. And of course, we want to make sure more people are growing their account, right? If everyone is in profit, we are happy. Okay, so when we're spotting for Fibonacci, ultimately we need to first spot the patterns on the chart. So there's 4 patterns with Fibonacci. This is called the retracement. Oh, sorry. I'm trying to draw a retracement the other way. Okay, yeah, got it. Okay, this is called the extension. How do I draw an inverse one? I can't, I'm trying to imagine it. Okay, there you go. And this is the projection. Okay, let me just explain these in detail, like just briefly. Okay, before you even find Fibonacci, what time frame are we using? Just give me a moment, Patrick. I'll get into that shortly after I do a brief introduction on Fibonacci. Okay, so before you even use Fibonacci, you need to identify the patterns on the chart. So this is called the Fibonacci retracement. This is the first one that you want to identify. If it's there, you have to ask yourself, okay, is there a Fibonacci retracement on the charts? So Fibonacci retracement basically looks like a V. Okay, it looks like a V, but the back end of the V is shorter than the front end. Do you guys see this? Okay, it is shorter than the front. So it can look like this. It can be inverse as well. So it can be like a mirror image of it, like the other way around. Okay, so this is a Fibonacci retracement. Fibonacci extension, it looks like a Nike tick. So Nike, you know, the shoe brand Nike. I'm sure everybody knows Nike, the running shoe brand or basketball, whatever it is. Okay, it looks like a tick. There is one right here. Do you see here? This is a Nike tick. Okay, so this is a Fibonacci extension. It can be inverse. The other one is the Fibonacci expansion, which we have here on the chart. It kind of looks like an N, or it can be inverse. And the other one is Fibonacci projection, also an N pattern or a zigzag pattern, and it can be inverse as well. Okay, so let me explain. Fibonacci retracement has 5 levels. So let's say I spot a Fibonacci retracement on the charts. Okay, I spot a Fibonacci on the charts, Fibonacci retracement. I'm going to go to the Fib retracement tool at the side. I'm going to go from the swing high. I'm going to pull it to the swing low. Okay, I'm going to go into the settings. Okay, and I'm going to remove everything. How do I remove everything? Sorry, excuse me. Okay, I'm going to remove everything, and I'm only going to pull out the 5 Fibonacci retracement levels, which is the 23.6, the 38.2, the 50%, the 61.8%, and the 78.6%. Okay, so Fibonacci retracement, 5 levels you want to take note of. Okay, Fibonacci extension level from the swing low, you look at for Fibonacci extension. Okay, sorry, 3 levels. 127.2, 138.2, and 161.8. Let me just change this. Okay, 161.8, you're going to pull it, and then these three levels are going to come out, and these are the three levels that you expect price to go to. Okay, for Fibonacci expansion, you are going to pull from the first part of the N pattern or the zigzag pattern to the second part of the zigzag pattern, and then you're going to pull out the two negative levels that we look at. So negative 27.2 and negative 61.8. For those who are just learning this for the first time, don't worry, there's no way you can remember everything, especially since I'm only going through it one time. I'm sure we will have a webinar on Fibonacci series, okay, but it's not a hard topic. It's just that there are particular settings and particular level that we take note of, okay? So it's not so much that it's hard, it's just that it's just things that you need to write down, and then you come back and refer to it. When you're using the Fibonacci, you just come back to your notebook or whatever it is to refer to the levels that you're supposed to be using. Okay, so Fibonacci expansion, the two levels that we're using are the two negative levels. Okay, and Fibonacci projection, the levels that we're using for Fibonacci projection retracement, because you're not taking, well, now you're taking 3 points. You take from the swing low to the swing high to the swing low, and then we use it to project levels from 61.8%, 78.6%, and 100%. So these are the three levels that we look at for Fibonacci Fibonacci projection. Okay, these are the basically levels. So there's 4 Fibonacci's that we look for. All 4 has different levels that we look for, and all 4 has 4 different patterns that we look for. Okay, so that's just a very brief introduction. I won't be able to spend too much time on Fibonacci. It's a very, very important thing to learn, but I won't be able to spend too much time on it today, because today our topic is multi-time frame analysis. Okay, so let's just try to stick to the topic today. And next time when there is a Fibonacci class or webinar, you guys can hop on, and then we can do a lot of you can do a lot of practicing with Fibonacci. So I don't think Fibonacci is hard. It's just a lot of practicing. It's just training your eyes to be able to spot the pattern and remembering the levels that you need. So actually, to be honest, if you have a notebook, you just write down the patterns that you should be spotting. You just have to write down the levels that you should be looking at. You should be fine. Trading is not hard, it is the learning part that is hard, okay? Okay, so let's start with our topic for today, which is multi-time frame analysis. Give me a second, I'll turn this air conditioner off, it's too cold. Okay, can you guys let me know in the chat box which time frame do you guys think is the most important? Can you guys let me know in the chat box? Okay, we have answers coming in already. I've got someone saying 1 hour. Okay, Jesse's saying 1 hour. I've got another person saying 1 hour. Those who are shy to answer to public, you can just send the message directly to me. Okay, so Osta, sorry Osta, I'm pronouncing your last name instead because I'm not very sure how to pronounce your first name. So Osta is saying 4 hours. We've got someone else saying 4 hours. Someone else saying 4 hours. Okay, most of you are saying 4 hours. Kingsley saying 4 hours. Another one of you saying daily. Another one of you saying daily. Another one of you, Shahid, saying 4 hours. Okay. That was a trick question. I'm so sorry. Okay, there is no time frame that is more important or better than another time frame. What time frame we look at depends on what kind of trader you are. So when you look at the time frame, you choose the time frame you want to use, you need to ask yourself, what trader am I? So there's 3 kinds. Am I a scalper? Am I a day trader? Or am I a swing trader? So a scalper is someone who is in and out of the market really, really fast. Okay, so they're in and out with the market really, really fast. Please, can you start with the daily? Yes, we can start with the daily. Just give me a while, Kingsley. Okay, so a scalper is someone who goes into trade that are very fast. They go in and they come out. So their trade can last from anywhere from 5 minutes, maybe 5 minutes to 10 minutes to 1 hour, 2 hours, 3 hours, 4 hours. Okay, so that is a scalper. we have another kind of trader called a day trader. Their trades usually last for 24 hours. Okay, they usually close out their trade within 24 hours before the day ends. Okay, and the last kind of trader is the swing trader. So swing traders can be people who hold their trades for more than a day, for days, for weeks, or for months. Okay, so these are swing traders. Can you guys let me know in the chat box what kind of trader you are so that we can decide which time frame we're going to look at? Okay, so Jesse's the scalper day trader. We've got someone saying swing trader. King. Oh, okay. There's two Kingsley in the chat. Sorry, I was calling. Okay, so there's Kingsley Emerson saying scalper, day trader, swing trader. Shahid is a swing trader. We've got another swing trader here, another scalper, another day trader. Okay, so I think the crowd is a little mixed today, right? You guys are a bit mixed today. Okay, so let me just break down what kind of time frame you should be looking at. If you are a scalper, you should be looking at the time frame 1 hour and below. So 1 hour, 30 minutes, 15 minutes, 5 minutes, 3 minutes. Okay, that is the time frame you should be looking at. If you are a day trader, you should be looking at the 1 hour and maximally, okay, on the maximum, the 4 hours. Okay, even if you look at the 4 hours, sometimes the trade may last for 2 days. Okay, so that's not really day trading anymore, right? But it's not as long as swing trading. For swing trading, you look at the daily, the weekly, and the monthly. Okay, the daily and the weekly and the monthly. So let me break down to you why these time frames affect the type of trader that you are. Okay, why I am a day trader. I chose to be a day trader because I am a prop trader. I am an analyst. I am an investment analyst, right? I'm a forex analyst. So it is my job to look at the charts every day. This is literally my livelihood. So because I look at the charts every day, it makes sense for me to be a day trader. Why I'm not a scalper? Because sometimes I'm writing reports and I can't really scalp, right? I need to write reports. I still need to look for strategies. I still need to do. So I think day trading is suitable for my lifestyle because I look at the charts every day. I come back to the charts and it complements my lifestyle. It suits my lifestyle. Okay, but let's say you are someone who, let me think of an example. You are someone who runs a business. You have 4 kids. You are someone who is super, super duper busy. Okay, you travel a lot. You're on the plane a lot. You are someone who cannot be in front of the computer so often. You cannot be looking at the charts so often. Okay, you go out a lot and you don't want to be on your phone looking at charts. You can consider being a swing trader. Why? Because swing trader means that you're looking at the daily time frame, the weekly time frame, and monthly time frame. That means you only need to come back and look at the charts maybe every week. You look at it once a week. Maybe you look at it once a month. You look at it once in 2 weeks. You look at it every 3 days, every 5 days, whatever it is. Okay, it's different from day trading because day trading requires you to come back and look at the charts every single day. Every day you need to come back to the charts and see, oh, what's going on today. Okay, swing trading, you can come back every week. Okay, but let's say you are a scalper. You for some reason you are a full-time prop trader. Okay, you are a full-time trader. You just take trades over and over, back to back. You can be a scalper, and in a scalper you can go to the smaller time frames. Okay, and also in scalping, it's for people who want to make very quick trades. You go in and out, go in and out, go in and out. Why I didn't choose to be a scalper? It's because I feel like scalping is very tiring, right? I like to just look at the charts once a day. I spend maybe half an hour or 1 hour a day on the charts, and then I go live my life. Okay, I don't want to spend too much time on the charts. I don't think it's healthy. But if you are a scalper and you really enjoy it, you really love looking at charts, then yes, you can look at the smaller time frames. Okay, so because I see most of you here are scalpers, day traders. Let me see, scalpers, day traders. We've got a few swing traders. We can just break down. Okay, so let me show you what the difference would be if you are making your analysis on different time frames. Okay, so I think earlier on, Kingsley was requesting for me to look at the daily time frame, right? I see your request, Kingsley. Don't worry. Kingsley Israel. Very nice name you have. okay, to start with the daily time frame. So let's start with the daily time frame. Okay, so there's two things we're going to do now with the daily time frame. If we're looking at the daily time frame, that means we are either we are most likely a swing trader, okay, a day to swing trader, right? So if you are looking at a daily time frame, you can first use a daily time frame as a reference to go to the 4 hours. Okay, that means you go to the daily time frame to look for information, and then you go for the 4 hours to refine your strategy and refine your analysis to look for an entry, stop loss, and take profit. Or what you can do is go to the weekly to look for information, look for relevant zones, relevant lines, and then go to the daily time frame to look for your analysis and refine your strategy. Okay, so let's just quickly do an analysis on the daily time frame, and then I will show you how it would differ if you were to do an analysis on the 4 hours, for example. Okay, so let's say on the daily time frame. On the daily time frame on BTC USD, we are looking at BTC USD right now. Can you guys let me know in the chat box, do you think BTC USD is going in an uptrend, or do you think it's going in a downtrend? This is a very important question you have to ask yourself when you are looking at the charts. Why? Because this will determine whether you are going in for a buy or a sell. Okay, thank you, Jesse. Anyone else? Thank you, Ismail. Thank you, Emerson. Thank you. The other Kingsley, sorry, I cannot pronounce your first name. Inechukwu. I'm not sure if I'm pronouncing it right, so I think to be safe, I'll just call you Kingsley. And the other Kingsley Israel. Okay. Okay, so everyone is saying it's a downtrend. You are right, because price is making lower highs and lower lows. Okay, so price is definitely moving in a downtrend on the daily time frame. Okay, so let's just try to highlight maybe a channel or a trend line if it's available. Okay, let's try with a channel. Okay, there is a channel. So a valid channel, you will need 2 touches on top and 2 at the bottom. This satisfies our channel. Of course, the more touches, the better, but on the minimally, we need 2 touches on top and 2 touches at the bottom to make it a valid channel. Okay, another thing I might see is an even smaller channel. So there's a big channel here, but there might be an even smaller one. Let me try to see if this smaller one will work. Right. Okay, so there is also an even smaller channel here. So I am going to just leave that. Sorry, give me a moment. Okay, you know what I've noticed? I noticed that price has done a channel breakout on the smaller channel, but remember, it is still moving in a bigger channel. So you know, when we're looking at a daily, this could mean 2 things. One is that it is a short-term uptrend. Why is it an uptrend? Because price was moving in this smaller channel, right? Okay, let me just change the color so that you guys know what you guys can, it's clearer for you. Okay, so price is moving this smaller red channel here. It broke out of this channel here, which is indicating bullishness. Okay, anytime there's a breakout of channel or breakout of a zone or breakout of anything, it just means that there is possibility of bullishness. Okay, it could mean that it's a short-term bullishness, but a long-term downtrend. Why? Because on the long term, it is still moving in that big channel, right? On the long term, it is still moving in a bigger channel. On the short term, it has just broken the smaller channel. Okay, so let's just highlight a few support and resistance so that we can kind of roughly get our bias. Because of this break of this channel, I'm not so keen on looking for a sell entry anymore. And maybe we can look for a buy from here to the bigger channel. Okay. Okay, so let's just highlight a few horizontal levels. Okay. Okay, so this is a resistance. I'm going to change the name so it's clear for you guys, and so that when you're doing analysis, charting yourself at home, you guys will know what to look for and whatnot. Okay, so there's two things I much rather do right now. The first thing is that I much rather, okay, I much rather look for a sell entry. Okay, I can look for a sell entry from here. Why am I looking for a sell entry? Because I think price is still respecting this channel. Or I can look for a buy entry where I go in from here to here. And then from here, I look for that sell to here. Okay, you guys see that? Do you see how from the information you collect on the charts, you are able to come up with a lot of analysis and where you think price is going? So just based on the channels alone, I think there's going to be a bit of some bullish momentum. There might be a bit of bullish momentum. And then when it gets here, there's going to be resistance. Okay, there's going to be resistance. And then I think price is going to reverse from here back to here. Okay, let's use some Fibonacci levels or whatnot to see how accurate my rough analysis is. Okay, for those who've never heard this, let me tell you an analogy. For those who have heard this, because I take you guys I've been taking you guys for a few weeks now. You guys probably heard it. Okay, so this guy's name is Bob. Okay, Bob is walking to the right. Okay, Bob is walking to the right. Okay, he reaches a door. If the door is heavy, it is made out of stone, it is made out of very heavy metal, for example, or the door is locked, for example, Bob will keep pushing the door, and he's going to fail to open the door, and therefore he needs to turn back. Okay, he's going to turn back, and he's going to U-turn and turn back. Okay, if the door is light, it is unlocked, there's nothing behind the door, there's no barrier, he can safely and easily open the door, push it open, and go into the next room, right? Do we all agree with this analogy? Right, so it is similar to price. It is similar to price. Right now, your support and your resistance, okay, let me change this to first support, works as the door. Price is Bob. Anytime price reaches a resistance or a support, it's going to try to push that resistance or support open. Okay, it's going to try to push the door open. If it successfully pushes the door open, it will go higher. Okay, it will break and it will go to the next room. If it doesn't, it will reverse. Okay, it will reverse and it will make a U-turn and it will reverse. Okay, if it doesn't, it will just reverse. So right now, our job as a trader is to first identify where your support resistance is, identify where the door is, so that when price gets there, you need to ask yourself, is price going to break higher or is it going to reverse? Okay, we don't know, is it going to break higher or going to reverse? So how we see if price is going to reverse or break higher, we need to identify the strength of this resistance or this support. We need to identify how strong these levels are. The stronger it is, the harder it is for price to break it, and therefore it will need to reverse. And when it reverses, we get in for, that's when we decide if we get in for a buy or a sell. If it reverses at the first resistance, can you guys let me know in the chat box, do we get in for a buy or a sell? I just want to know if you guys are still following. If price gets the first resistance and the first resistance is a very strong resistance, do you think we should be entering here for a buy or a sell? Okay, thank you, Kingsley. Thank you, Jesse. Thank you, Ismail. Thank you, John. Thank you, William. Thank you, Will. Okay, cool. So right now, most of you say sell. Thank you so much. I'm glad you guys are still following. Okay. It means that if we think it's going to be a sell here, it means that we think this area is a very strong area. We think that this door is very strong and price will have a hard time opening this door, and therefore he needs to turn back. Okay, he won't be able to go into the next room, rather to the next zone. Okay, so how do we establish the strength of this resistance or this door? We use Fibonacci again, right? We use Fibonacci. Let's pull out our Fibonacci retracement. We are trying to identify Fibonacci retracement here. which is the V pattern with the shorter end, okay? We're trying to see if there's any Fibonacci retracement that lines up near or on top of our resistance, okay? So from this swing high, I'm gonna pull to the swing low. I'm gonna pull out my 5 Fibonacci retracement levels, okay? Can you guys let me know which Fibonacci retracement level is closest to our first resistance? I'll make it bigger so you guys can see it clearer for those who are watching this from your phone. Okay, thank you, Jessie. The rest? Thank you so much, Osta. Okay, yes, so the 38.2% is the closest level to our first resistance. Therefore, we're going to go into the settings, get rid of every other, thank you, Shahid, every other level that is not the 38.2%, because those levels are not relevant to us, okay? We are only focusing, we are just bringing our focus to the first resistance and the first support. Anything other than the first resistance and the first support, we're not that interested. Why? Because this first support and first resistance will work as our entry, stop loss, and take profit, okay? So we've got 38.2 lining up very nicely. I see an even bigger Fibonacci retracement here, okay? I see an even bigger Fibonacci retracement here. I see a Fibonacci projection here, okay? The zigzag pattern, okay? So let's see if any Fibonacci levels are lining up there. For those who are still confused, don't worry. Fibonacci is not hard. It's just training your eyes to be able to spot. Okay. Okay, so in this case, I see the 28. If I pull out all the 5 levels, the 23.6 will be the closest. So I'm going to only leave the 23.6 level. Then I'm going to get rid of the rest. Let's see the zigzag pattern, if we can find any level that lines up close. Okay, no. Let me see the bigger zigzag pattern, if any levels line up close. Okay, we've got the 78.6. Okay. For the zigzag pattern, which is the Fibonacci projection, these are the 3 levels that we look at. So in this case, the 78.6 is closest to our first resistance. We're going to get rid of everything else, and we're only going to keep the 78.6. Why? We want to keep our charts nice and clean, right? We want to keep our charts nice and clean. Okay. Now that I've identified my Fibonacci levels, I'm going to highlight this area. Why? Because actually support and resistance is not one number. Okay? It's never one number. It's actually a zone. It's more like a zone. Okay, so I'm going to highlight this zone. This is our first resistance zone. I'm going to turn it to red so you know that it's resistance. Anytime it's green, it's support. Red means resistance. That means when, okay, so let me go back to my bob. Where is my bob? Okay, there it is. Okay, so what does Fibonacci represents in this analogy? It represents barrier behind the door. Okay, right now you have Bob trying to push this door open. We don't know if the door is going to push open or not, but we know there's a door there. So the door itself is already a form of barrier, right? So Bob already has some kind of resistance before he can go to the next room. Now we have 3 Fibonacci levels lining up in the exact same area or near the first resistance. So what does this Fibonacci represent? It represents 10 kilo rocks behind the door. Okay, it represents 10 kilo rocks. For every Fibonacci levels that lines up near or on top of the first resistance, it represents a 10 kilo rocks. So kilos and rocks. Okay, yes. So the Fibonacci, thank you, Jessie. Thank you, everyone. Thank you, Ismail. Thank you, Kingsley, Shahid, Emerson. Okay, so the Fibonacci levels represent rocks that are behind the door. So in this case, there is a lot of barrier here, don't you think? There is the first resistance there. There is 3 Fibonacci levels lining up here. And on top of that, there is a channel, descending channel, all lining up in this first place. So my question is, when price gets to this area, do you think price can easily break this area, or do you think it's going to reverse from here? Can you guys let me know in the chat box? When price gets to our first resistance, do you think it is higher chance of a reversal or higher chance of break? Okay, thank you so much. Thank you, Shahid. Thank you, Jesse. Thank you, Joash. Thank you, William. Thank you, William Williams. Okay, thank you, Kingsley. Yes, the chances of it reversing is higher, right? I cannot say for sure, right? There is a possible reversal. Thank you, the other Kingsley. I like that you use the word possible. Why? Because our job as a trader is never to be like, oh, okay, price is going to reverse from here. 100%, I am 100% sure that this is a sell. I'm 100% sure. It's never 100%. Our job as a trader is only to find the higher possibility, okay, the higher probability. So when price gets to the first resistance, we have, there is a higher chance of reversal than there is of a breakout. Why? Because of all the information that we have collected. Based on the information that we have collected, we think that the possibility of a reversal is higher than of a breakout. So therefore, if price gets here, we are getting in for a sell. We will be looking for a sell entry. Okay. Okay, cool. So let's do this one first, where we're looking for a sell entry, right? We're looking for a sell entry from here, from our first resistance to our first support. Why the first support? Because price is always attracted to key levels. So let's say Bob breaks this door open, he goes into the next room, right? When he goes into the next room, when he reaches that room, there's going to be another door here. When he opens this door, there's going to be another door in the next room. Okay, if he doesn't open the door, he turns back, behind him there's another door. Okay, so Bob is basically just in between a lot of doors. Okay. Okay, so we think that price is going to reverse from here to here. Now that we have found our analysis based on support resistance, based on trend, and based on Fibonacci levels, we are going to back our analysis up with indicators. That means we need the indicators to agree with us, okay? It's the same thing. I've told you guys this story many times. Let's say you are going to buy a pink dress, okay? You don't know if the pink dress is nice or not. So you ask your mom, hey mom, do you think this pink dress looks good on me? If your mom says yes, it will convince you to buy the pink dress. You ask your dad. If your dad says yes, it will give you even more confidence to buy the pink dress. If you ask your brother, your sister, everybody says yes, then you're definitely getting the pink dress. Why? Because you are confident that you look good in that pink dress and therefore you want to get it. So similarly with looking for trades and setups, now we think it's a sell. We think that it's a sell from the first resistance to the first support. We now need the indicators to confirm our analysis, to support our analysis, to tell us, yes, you are good for the sell. Okay, so when we go into the indicators, remember guys, there are so many technical analysis. Look at this, there's hundreds of technical analysis out there. So which analysis do you use? These are some of the analysis, these are some of the indicators. Did I say analysis? Okay, so there are hundreds of indicators out there. So which indicators do you use? These are some of the indicators that we use here at Average Fortune Group. Why? Because from back testing and strategy testing, we find that these indicators give us quite accurate information. We're not saying that the rest of the indicators are not good. It's just that these are the indicators that we are used to using. Okay, we find that these are good enough. Okay, so we don't really use the others. Okay, okay, so let's pull out Bollinger Band, for example. Let's see what Bollinger Band is saying. Okay, Bollinger Band is not telling us it's a sell. In fact, Bollinger Band is not saying much. If anything, Bollinger Band is not saying much. Why? Because Bollinger Band, we use it as a support and a resistance. Actually, if anything, Bollinger Band is telling us it's a buy. Okay, we're gonna get rid of Bollinger Band. Okay, let's see what the Ichimoku cloud says. Okay, Ichimoku cloud. Give me a moment. Okay, Ichimoku cloud is not supporting our analysis. Why? Because for price to get to the first resistance, it needs to break our cloud before it can reverse. So whenever price breaks the cloud, it means that it's a buy already. If price breaks the Ichimoku cloud to the upside, it means it is a buy. Okay, so right now we have looked at two indicators, and two indicators are not supporting our analysis. Let's see if RSI, stochastics, MACD are supporting our analysis. Okay, for those who don't understand how to use these indicators, I'm so sorry I wouldn't be able to explain every indicator in detail today. Okay, because these are topic on its own. The only thing possibly agreeing is stochastics. Okay, because when price reaches this area and reverse the resistance, similarly on the stochastics, it will reach and we will be looking for a resistance as well. RSI should also be supporting. Okay, let me see, MACD, not saying much. If anything, MACD is suggesting that there is a lot of bullish pressure right now. Okay, so we have pulled out 5 indicators. 2 agree with us and 2 does not agree with us. Do we still take this trade? That is the question. Okay, you ask 5 people if the pink dress looks good on you. Sorry, you ask 4 people if the pink dress looks good on you. 2 people tell you, actually you ask 5. 2, your mom and your dad say, yes, the pink dress looks good on you. Your brother and your sister say, no, don't get the pink dress, it doesn't look good on you. And you ask your cousin say, I don't know, I don't have an opinion on this. Do you still get in for this? Do you still buy the pink dress? Do you still get in for this sell? Can you guys let me know in the chat box what you would do? Okay, no response. I'm assuming everyone is confused as well. Nobody knows, should I get this pink dress? I would hold it off. Okay, I think that is a form of discipline. I think that's a form of discipline. Okay, so there is a saying that I live off by. When you are unsure, stay out. Okay, when in doubt, stay out. Okay, but some traders will look at this and be like, there is still a chance that I might win this trade. So if you are a risk taker, right, and you don't mind taking that risk, you can still get in on this trade. Yep, you can still get in a trade, but get in at a smaller lot size. So for example, if you were going to risk 1% on the trade, for example, and now you look at this setup, it's an okay setup, but right now 2 indicators are not agreeing with me. 2 indicators are agreeing with me, 2 indicators are not agreeing with me. Ichimoku Cloud is actually saying that it's a possible buy already. Okay, Bollinger Band is saying that it's a buy, but stochastics and RSI is saying it's a sell. Okay, so I think there's still, if I listen to stochastic and RSI, I do think that there's a good chance that it's a sell, right? So it's just, again, our job as trader is to look for probability and to collect information. After we collect information, we decide where the markets are going based on the information we are collecting. So based on the information we are collecting, it is a sell, but there's signs that it's a buy. Okay, there is some signs it's a buy, but I think there is more things telling me to sell. So if you were going to risk like 1%, let's say you were going to risk $1,000 for this trade. Now it's not so clear, it's not as confident. Instead, what you can do is risk 500 instead, risk 300 instead, risk less. So you can still get in on this trade. Sometimes I do still get in on not very high probability trades. Okay. Sometimes I still get in it, but if you are going to get in it, get on in it with a smaller risk. Okay, risk less. So you can still get in, but risk less. Okay, so this is what we are looking at on the daily. On the daily, it kind of looks like it's a sell because of the bigger channel, because of the resistance, horizontal resistance, because of the 3 Fibonacci levels lining up in the same area. It kind of makes us feel, because of stochastics, because of RSI, it makes us feel that it's a possible sell. Okay, let's go to the 4 hours. Okay, let's go to the 4 hours and see, do we think it's a sell? Okay, if I am looking at the 4 hours, right? Because I'm now at the 4 hours and I'm zooming in. I won't think it's a sell anymore. I won't think it's a sell anymore. Why? I would actually instead be getting in on a buy. Okay, why? Because I'm now looking at an even smaller area. Okay, let us get rid of all of this. Let's get rid of all of this. Okay, first things first. What am I seeing? The first thing I see is that this was initially a resistance. Price broke this resistance and went higher. What is this indicating? This is indicating to me that this is a buy, that there is bullish pressure right now. Okay, it has broken this horizontal resistance here, which is indicating bullish resistance. It makes me want to get in for a buy. On top of that, it has broken this tiny channel here, which is this downtrend. Okay, so when I am on the bigger time frame, I'm more biased of a sell, because there's a lot of things that I can't really see, because on the bigger time frame there is still a bigger descending channel, right? There was an even bigger descending channel. But when I go to the small time frame, that bigger descending channel is not relevant to me anymore because it is too far away. Remember, there was a descending channel that was lining up here. Okay, so on the 1 hour, it looks like it was closer to price, but on the 4 hours, it still looks like it's quite far away. So it's not that relevant for me. So instead, I can look for a buy. So you can see how on different time frames, on the same charts for BTC USD, on different time frames will tell you different things. Okay, on the bigger time frame, I might be biased for a sell, but on the smaller time frame, I will be biased for a buy. Why? Because it is short-term buy, long-term sell. Okay, so I can just play that buy to that sell area to the bigger time frame, and then I can sell from there. And plotting support resistance, how many touches? Support resistance, minimally 1. Honestly, just 1. Horizontal support resistance, you need just 1. But of course, the more touches, the better. The more touches just means that that is a very relevant support and resistance. I don't understand why we're not using the bigger channel. Okay, why? Because when I go on the daily time frame, okay, if I go on the daily time frame, guys, we're actually running out of time, so I hope for those who don't mind, you can stay on if you want. I can just do another 10 minutes or 5 to 10 minutes maybe. Okay, on the bigger time frame, this channel looks very relevant. Okay, look, it's still like, it looks very relevant. It looks like price is approaching, okay, our channel. But if we go to the smaller time frame, we go to the 4 hours, or even if we go to the 1 hour, maybe on the 1 hour would be even better. Do you see how far that channel is? On the 1 hour, I'm only looking at this small little area here, for example. Okay, I'm only looking for this area. On the 4 hours, I'm only looking at this small little area. It's that area that I'm focusing on the smaller time frame is this small area, but the channel is here. It's this big area here. So it's so far away from my focus point or my view that it is not relevant to me at this current point of time. You understand? But if I go to the daily, the channel, I can still see the channel, right? I can nicely see the channel. I can see the structure of the channel. But when I go to the 4 hours, because on the daily, I'm focusing on this area. But on the 4 hours, if I focus on that area, that's too big of an area. We want to focus on small areas. When I'm on the 4 hours, instead, I should be focusing on this area. When I'm on the 1 hour, I should be focusing on this area. Okay, so the time frame that you're looking at, you should be focusing on that area that is at least still in the screen, right? On the 4 hours, if I were to use that big channel, I would need to zoom out a lot. Zoom out. Do you see how small my candlesticks are? My candlesticks are so small. It's gonna be very hard to chart on this. Okay, so you're using a small time frame to refine your strategy. Okay, so in this case, this big channel, we can leave it there as reference, but honestly, it's not that much relevant when we're looking for entry. Okay, So when we're going to smaller time frames, we're using the smaller time frames to look for our entry, to look for a better entry. It can work as a very good take profit area. Okay, we can use this area here as a take profit area. But when we're looking for entry, honestly, this channel is not relevant to us. Okay, this channel is not relevant to us. Okay, so let's try to find a more relevant entry. Now, instead of looking for a sell, we are looking for a buy already because we are focusing on this area here. Okay, and when we focus on this area, what does it look like? It looks like it's going up. It is making higher highs and higher lows. Okay, it's making higher highs and higher lows. There's a higher structure, whereas when we were on the daily, it looks like it was on a downtrend. Okay, but now that we're on the 4 hours, it looks like it's on a uptrend. Okay, so we can be looking for a buy entry on the 4 hours. Let me get rid of all of this so that it's clearer. Okay, we can be looking for buy entry. So usually the buy entry I want to look for is the pullback to this area. It pulls back and retests this area, and I get in for a buy. Where do I buy it to? I buy it. That's actually too far. You see on the daily, if we're using the information on the daily for the 4 hours, it's actually too far. There is actually a closer resistance here. This is a much closer resistance here. Okay, this is your resistance. I'm going to put it as second resistance because it is another door, but that door is behind this door instead. Okay, so if we are getting in for a buy, I think on the minimal, it should come to this first resistance first. Okay, you guys see how different time frames on the same pair will be giving you different analysis and different charts, right? So based on this, I am getting in on a buy from here to here. That information we collected on the daily is not even relevant on the 4 hours. It's not even that relevant on the 4 hours, right? We can leave that there for reference. Okay, we can leave that there for reference, but honestly, it's not relevant. I can get rid of all of this and it does nothing for our current analysis. Okay, so think it is a short-term buy, at least to this area. Whatever happens from here, we need to wait for price to get here to decide again. Why do I think it's a buy? Because of the channel breakout, because of the horizontal level breakout. I think that's a good entry. That's a good area for entry. Why? It lines up nicely with the horizontal pullback area here. We've got a horizontal pullback area here. It lines up nicely with the 23.6 Fibonacci retracement. So I'm hoping that price does this pullback. When it gets here, wait for a reversal candlestick pattern. I cannot go through that with you today. Just type reversal pattern candlesticks in Google and look for reversal pattern candlesticks. Okay, so these are some of the examples. We've got bearish engulfing, bearish tweezer, bullish engulfing, bullish tweezer, dojis, evening star, hammer. Okay, when price comes back to this first support, you need to see a reversal pattern candlesticks that confirms the buy. Okay, that confirms the buy. You see that, you are good for the buy. If that does not appear, do not get in for the buy. Okay, again, back to the pink dress story. Your job as a trader is only to collect information and then decide if the information is good enough to make your decision. Okay, so you want to ask as many people as possible if your pink dress is nice. So you're asking your dad, your mom, your grandma, your cousin, your blah blah blah. Waiting for the reversal candlesticks pattern is basically waiting for another form of confirmation. Okay, that is another form of confirmation. If the reversal pattern candlestick appears here, it is a confirmation for a yes that you are good for the buy. Okay, so wait for the pullback, wait for the reversal candlestick pattern, and then you are good to enter for a buy. Why? Because of the channel breakout, because of the horizontal breakout, and because price is moving above the Ichimoku cloud. Okay, so we've got a few reasons to believe that this is a buy. Okay, but we need to wait for price to come here, and then we're getting for a buy. Why do we wait for price to come here, and why do we not just get in for the buy right now? Because getting in for the buy right now, right? Let me show you, okay? The difference with waiting for price to come back to your first support and getting in for your buy is your risk to reward. So I don't know if you guys have heard this saying. It was said by Robert Kiyosaki. Robert Kiyosaki said that you should be winning from entry onwards. The win should start from your entry onwards. Okay, so your entry, imagine you got in from here. Right now, you get in for this buy. Although I do think it will go to the first resistance, okay, you get in right now. If you get in right now, your risk to reward for this trade is, sorry, let me pull this, 1 to 2. That means if you have a $100,000 account, it's not even 1 to 2. Let me properly adjust. If you get in right now, okay, it's 1 to 123. 1 to 1.22. It means if you get in right now, if you have a $100,000 account, you are risking 1%, right? You risk 1%, so you risk $1,000. If price goes to your stop loss, you lose $1,000. If price goes to your take profit, you win $1,230. If you get in now, that's your risk to reward. But sorry, let's say your take profit is here. Sorry, that's not even your proper risk to reward, okay? Let's say your stop loss, is here, okay? Because you need to put a stop loss, right? Let's say your stop loss is here. Your risk to reward is actually 0.79, okay? If you get in here right now, you put your stop loss here below the first support, it's 0.79. You are risking $1,000 to make $790. That does not make sense. The risk to reward does not make sense. You are risking more to make less. But if you wait, you patiently wait for price to come back to your first support, you patiently wait for the reversal pattern candlesticks. This is your entry. Now your trade immediately becomes 1 to 3.7. That means if you lose, price goes to this stop loss here, you lose $1,000. But if you win $3,700 because the risk to reward is 1 to 3.7. Okay, so risk to reward is very, very super crucial in trading. Okay, it means that you are risking very little to win a lot. Okay, so we should be taking this kind of trades rather than risking a lot to make very little. I know for some of the new traders here, you may be experiencing it. When you see your trades in the win, you take profit prematurely, you make very little, but when you see it at a loss, you don't close it, right? I'm sure there's a lot of you, some of you here who do that, because when I started trading, that was me as well. When I'm losing, I will never close my trade. But when I'm winning, just even a bit, I will take the trade. But if you think about it, why are you doing that to yourself? That means that if you lose big, but when you win very little. At the end of the day, you're going to lose, right? At the end of the day, you are going to lose. So you should be taking less risk, more profit. Less risk, more profit. Less risk, more profit. So patiently wait for price to come back to the first support. If it doesn't come back to the first support, just take it that you missed the trade, okay? Don't chase the trade. Just take it that you missed the trade. Move on, look for another trade. Okay, that's all I have for you guys today. Thanks for joining. I will see you guys again.
My name is Emily, and today we're going to talk about hedging. Hedging is a risk management strategy which is applied to offset losses in investments by taking an opposite position in a related asset. Basically, hedging refers to reducing some sort of risk or exposure that could negatively impact your portfolio. It can be the risk of a specific stock or an industry experiencing a decline, the risk of interest rates rising, or inflation being higher than expected. Essentially, you can hedge by adding investments to your portfolio that move in the opposite direction. For example, you could hedge your exposure to a specific stock by shorting that same position. In doing this, you offset your loss, so if the stock drops in value, the short position will increase in value. Hedging strategies involve the use of financial instruments known as derivatives. Two of the most common derivatives are options and futures. With derivatives, you can develop trading strategies where a loss in one investment is offset by a gain in a derivative. moving on to the benefits of hedging. Risk mitigation. The main benefit of hedging is that you are able to manage risk and the investment exposure you have. Derivatives can be used to protect yourself if things don't go in the direction you expect. Now we limit losses. With hedging, you can limit your losses to an amount that you are comfortable with. The cost of the hedge will limit your gains, but your losses won't increase in the case of a price decline. Now we lock in future prices. Companies use derivatives to eliminate the uncertainty of future commodity prices. By using futures and forward contracts, they can lock in prices for essential goods well in advance of their delivery date. Now, the risk of hedging. Limiting your losses is one of the principal benefits of hedging, but it also means it will limit your potential gains. If an investment increases in value and the hedge is not necessary, you will lose the cost of the hedge. Hedging has a cost. This is either the direct cost of a derivative contract used to hedge or the cost of lower profits in return for some protection against losses. That's it for today, guys. Thank you so much for joining us. Stay tuned for more educational videos. Bye-bye.